In the grand theater of finance, billionaires have mastered the art of tax avoidance with a flair that would make Houdini envious. As of January 2025, their strategies have evolved, becoming more sophisticated and, dare we say, more entertaining. Let's pull back the velvet curtain and reveal the tricks these financial magicians use to make their tax liabilities disappear. The buy, borrow, die maneuver. Imagine living in a world where you never have to sell your assets but can still enjoy their benefits, a concept billionaires have turned into an art form. By holding onto appreciating assets like stocks, real estate, or fine art, they avoid triggering capital gains taxes. Instead of selling, they borrow against these assets at low interest rates, using the borrowed cash to fund lavish lifestyles. These loans often come with rates as low as 1% to 2%, significantly lower than standard income tax rates. When they pass away, these assets are handed down to heirs with a step-up in basis, erasing the taxable gains altogether. This strategy not only defers taxes, but in many cases, eliminates them entirely. To put this into perspective, Elon Musk reportedly used this strategy, taking massive loans against his Tesla shares while paying little to no income tax. Trusts. Trusts are the Russian nesting dolls of finance complex structures within structures designed to shield and preserve wealth. Billionaires frequently use grantor-retained annuity trusts, which allow assets to appreciate outside of their taxable estate. For example, Facebook co-founder Mark Zuckerberg has reportedly placed large portions of his wealth into such trusts to minimize estate taxes. Grantees allow billionaires to transfer assets to their heirs while avoiding the bulk of estate and gift taxes by valuing assets at their current price rather than their appreciated value. Additionally, trusts like dynasty trusts can hold wealth for multiple generations without being subject to estate taxes, essentially creating perpetual tax shelters for family fortunes. The Roth IRA loophole. The Roth IRA, originally designed as a humble retirement savings vehicle, has become a playground for the ultra-rich. Billionaires have found ways to funnel low-value private company shares into their Roth IRAs. When these shares skyrocket in value, all future earnings within the account remain tax-free. Tech mogul Peter Thiel famously turned less than $2,000 in a Roth IRA into a jaw-dropping $5 billion, all shielded from taxes. This loophole exemplifies how billionaires transform small sums into massive tax-free fortunes, leaving average taxpayers scratching their heads. While most Americans are limited by contribution caps, the ultra-wealthy bypass these rules by using Roth IRAs to invest in startups and private companies at an early stage. As these investments grow exponentially, the tax-free status of the Roth IRA allows billionaires to keep every penny of their gains. Charitable contributions. Donating to charity is undoubtedly noble, but for billionaires, it's also a masterclass in tax planning. By donating appreciated assets, such as stocks or artwork, to charitable organizations or donor-advised funds, they can claim significant tax deductions while avoiding capital gains taxes. Jeff Bezos, for instance, has donated billions to his Bezos Earth Fund, reducing his taxable income while championing environmental causes. In 2023 alone, American billionaires collectively donated over $50 billion to various causes, much of it in the form of appreciated stock. While the charity benefits, so does the donor's wallet. Donor-advised funds are particularly popular as they allow billionaires to park their money in a charitable account indefinitely, claiming immediate tax deductions without being required to distribute the funds right away. Offshore tax havens. Offshore tax havens like the Cayman Islands, Luxembourg, and Singapore aren't just vacation spots, they're financial sanctuaries. Billionaires and corporations alike use these jurisdictions to shield profits from high tax rates. Apple, for example, famously held billions offshore in Ireland to avoid US taxes. This practice, known as profit shifting, involves transferring profits to subsidiaries in low-tax countries to reduce overall tax burdens. In 2024, global tax watchdogs estimated that over $700 billion in profits were parked offshore by multinational corporations. While such practices are often criticized, they remain perfectly legal under current tax laws. The 1031 exchange. Real estate investors have long used the 1031 exchange as a way to defer taxes. This rule allows them to swap one investment property for another like-kind property without recognizing capital gains. For billionaires, this means they can keep trading up properties from a small apartment complex to a sprawling commercial empire, all without paying taxes along the way. Donald Trump, among others, has reportedly used this strategy extensively in his real estate dealings. In 2024, real estate investors deferred an estimated 100 billion in capital gains taxes through 1031 exchanges. This strategy not only saves money, but also enables investors to reinvest their gains into higher value properties, compounding their wealth over time. It's like playing an endless game of real estate monopoly, where every trade brings you closer to boardwalk, but never closer to a tax bill. Carried interest. Private equity and hedge fund managers have a nifty trick up their sleeve: carried interest. This allows their earnings to be taxed as capital gains instead of ordinary income, resulting in significantly lower tax rates. For context, capital gains tax rates top out at around 20%, compared to the 37% rate for ordinary income. Billionaire investor Stephen Schwarzman, co-founder of Blackstone, has been a vocal proponent of this strategy, which has saved him and his peers millions. Critics argue that this loophole disproportionately benefits the ultra-wealthy, but efforts to close it have repeatedly stalled in Congress. In 2025, the carried interest loophole remains one of the most controversial aspects of the tax code. Family limited partnerships. Family limited partnerships are a cornerstone of generational wealth transfer strategies. By transferring assets into an FLP, billionaires can claim valuation discounts, reducing the taxable value of their assets. These partnerships also allow for centralized control, ensuring the family's wealth remains intact. The Walton family, heirs to the Walmart fortune, have reportedly used FLPs extensively to minimize estate taxes. In 2024, it was estimated that FLPs helped families shield over $200 billion in assets from estate taxes. These partnerships often employ valuation discounts of 20% to 40%, significantly reducing taxable estates. It's like hosting a family reunion where everyone leaves with a smaller tax bill instead of leftover potato salad, and everyone is happier for it. Intellectual property. Companies often transfer their intellectual property, IP, to subsidiaries in low-tax jurisdictions, effectively shifting profits to areas with minimal taxation. For example, Google's use of the double Irish with a Dutch sandwich strategy allowed it to pay a fraction of what it would owe under standard tax codes. Although Ireland began phasing out this loophole in 2020, variations of the strategy persist in other jurisdictions. By 2025, tech giants were estimated to save over $150 billion annually through similar IP migration strategies. This practice highlights the ingenuity of tax planners in finding new ways to reduce liabilities. It's a high-stakes game of hide-and-seek, with profits playing the part of the elusive hider while governments scramble to keep up. The double Irish with a Dutch sandwich. This infamous strategy involves routing profits through Irish and Dutch subsidiaries to minimize tax liabilities. While Ireland has begun phasing out this loophole, its legacy endures. Companies like Microsoft and Apple have saved billions using this method, showcasing its effectiveness. In 2024, global tax authorities reported that variations of this strategy were still used by over 1,000 multinational corporations. It's the only sandwich that leaves you richer and the taxman hungrier. Despite global efforts to shut it down, variations of this tactic continue to thrive in 2008, proving that when one door closes, a tax loophole often opens. The winds of change. Governments worldwide are increasingly attempting to close these loopholes. In the US, proposals like Senator Ron Wyden's Billionaires income tax aim to tax unrealized gains, targeting strategies like buy, borrow, die. Meanwhile, international efforts, such as the OECD's Global Minimum Tax Initiative, seek to curb corporate tax avoidance. In 2024, over 130 countries agreed to implement a 15% global minimum tax, though its full enforcement remains a challenge. However, the effectiveness of these measures remains to be seen as tax planners continuously adapt to new regulations. As of 2020, the game between legislators and billionaires continues, with both sides innovating at breakneck speed. And that's a wrap. If you found this video into the tax tricks of billionaires both eye-opening and entertaining, don't forget to hit that like button and subscribe to our channel.